Hello, this is Dave Toth with an RJO MRT Technical Webcast update on the E-Mini S&Ps and the 10-year T-note markets for Friday, June 1st. Starting off here with an intraday 4-hourly chart of the June S&P market, you can see today's sharp break below last week's 294 and 287 lows. That confirms our suspicions that that interim recovery attempt was merely a three-wave and thus corrective sequence within the broader developing bear trend. And as a direct result of today's weakness, the market has defined the 1319 high from yesterday afternoon as the latest corrective high and absolute tightest risk parameter this market is now minimally required to recover above to jeopardize the impulsive integrity of a broader bearish count and expose a larger degree correction or reversal higher. And in lieu of such strength above at least 1319, further and possibly excessive losses are anticipated straight away. Moving to a daily log scale chart shown here, you can see the developing potential for a bullish divergence in momentum, but as a direct result of this week's broader relapse below the 1287 low from May 21st, the market is defined at 1334 high from May 30th as the corrective high and risk parameter, larger degree risk parameter, this market is required to recover above to confirm that divergence and stem this broader sell-off and possibly complete a five-wave Elliott wave sequence down from that March 27th high at 1420. In lieu of strength above 1340, we don't know that this market isn't going to go ballistic to the downside in a more third wave extension move that could really see or produce accelerated losses straight away. It is interesting to point out that the market is now engaging the 1276 50% retracement of the entire November-March rally from 1147 up to 1420, which is a neighbor of the 38.2% retracement on a weekly log scale perspective, the 38.2% retrace at 1273 of the entire October through March rally from 1068 up to 1420. But we would remind traders again that merely derived technical levels like Fibonacci relationships are poor reasons to expect technical support in the face of such a clear and present downtrend. It's also noteworthy that this week's price action is an outside week. We made a higher high and a lower low from last week, and we're obviously going to close lower on the week, and that's consistent with a broader bearish count that could produce sharp losses straight away. In sum, a bearish policy remains advised with strength above at least 1319 and preferably 1334 required to defer or threaten this bearish count, and per such, recovery attempts are advised to first be approached as interim corrective selling opportunities ahead of further and again potentially steep losses straight away. Moving to the 10-year T-note market on the actual yield basis, the daily log close only chart here shows the absolute collapse in yields, and the trend in yields is down on virtually all scales, with strength above at least former support turn resistance in the 1.69% area, and preferably strength above the 177 yield, corrective high yield from May 24th required to expose a larger degree reversal higher in rates. Looking at 10-year T-note prices on a weekly perspective, the trend is up on virtually every scale, and further and possibly accelerated gains continue to be expected straight away. On a daily close-only chart basis of the now prompt September futures contract, the trend clearly is up on this broader scale, with the 1.77% yield equivalent cutting across at the 132.08 corrective low from May 22nd. The long-term trend is considered up until this market breaks below 132.08 on a close-only basis. Looking at an intraday 4-hourly chart of the September T-note contract, clearly the trend is up, and by virtue of today's latest and accelerated spate of strength, the market has defined the 133.14.5 low from yesterday as the latest corrective low and tightest risk parameter this market is minimally required to fail below to jeopardize the impulsive integrity of this clear and present uptrend and suggest even an interim corrective setback, let alone a larger degree reversal lower. In sum, a bullish policy, a full bullish policy remains advised in the T-note market with weakness below at least 133.14 and preferably 132.11 to defer or threaten this count sufficiently to warrant defensive measures. Please stay tuned to updates on these and other markets on our RJOMRT.com website, and good luck with today's trading.